A brief background on Petronas, which stands for Petron National Berhad. Petronas was established on August 17, 1974, and is fully owned by the Malaysian government. The company headquarters is located at the iconic Petronas Twin Tower in Kuala Lumpur. Over the years, Petronas has grown into a global energy and solution company operating in more than 50 countries worldwide. Some of the key regions where Petronas is active include Asia, Africa, and Middle East. Petronas is known for its fully integrated operation. This includes the upstream activities such as oil and gas exploration and production, midstream operation like gas processing and transportation, and downstream sector which cover refining, marketing, and petrochemical and shipping. This complete integration allows Petronas to manage entire oil and gas value chain efficiently.
Petron Malaysia Refining and Marketing Berhad focuses on refining crude oil and selling fuel in Malaysia. Its main facility, the Port Dickson Refinery, produces products like petrol, diesel, and jet fuel. The company distributes fuel through service stations and to industrial users. It also supplies aviation fuel, make engine lubricants, and produce industrial chemical used in manufacturing. To support its operations, Petron manages its own logistics system, including a pipeline and terminals. Recently, it has also begun exploring renewable energy to support a greener future. In short, Petron plays a key role in Malaysia's energy sector by combining a traditional oil and refining with a clean energy efforts.
From 2022 to 2024, Petronas has a higher inventory turnover than Petron, meaning it sold its stock faster, but both companies show a decline. Petronas dropped from 252.36 times to 188.87 times, while Petron fell from 16.34 times to 12.26 times. This drop could be due to a slower sale, but stock kept in storage, or lower market demand. Even though Petronas is still more efficient, both should improve their inventory strategy to perform better and reduce costs. Next is DSO. DSO show how fast a company collect money from a customer after a sale. Petronas made a big improvement. Its DSO dropped from 55 days in 2023 to just 14 days in 2024. It means they are collecting payment much faster, maybe because of a strict credit policy, while Petron stayed about the same, around 20 days, showing a steady and consistent payment collection from customers. Next is the fixed asset turnover. From 2022 to 2024, Petron consistently has a higher fixed asset turnover than Petronas, with a value always above 15 times. This shows Petron has a very effective in using its fixed asset to generate revenue. Meanwhile, Petronas show improvement from 8.92 times to 10.13 times, meaning it's getting better each year but still behind Petron. In short, Petron is making the most out of a fixed asset, while Petronas is slowly catching up with the steady progress. Total asset turnover show how well a company uses its asset to make revenue. Petron is doing better, with a steady rate of about 3.7 to 3.8 times. Petronas improved from 3.26 to 3.55 times, which is a good sign. Even though Petronas is improving, Petron is still better at using its asset to earn more money.
Petronas Dagangan Berhad shows a very strong financial position, with its debt-to-capital ratio decreasing from 3.09% in 2022 to just 1.75% in 2024. This means that the company uses very little debt and is mainly financed through equity, which lower financial risk. On the other hand, Petron Malaysia Refining and Marketing Berhad has much higher ratio, around 34% across all 3 years. This shows they rely heavily on debt to run their operations, which can be risky if earnings drop or interest rates goes up. In short, Petronas Dagangan Berhad is more financially stable, while Petron is more exposed to debt-related risks. For time interest earned, or TI, we can see a big difference between these two companies. Petronas had a very strong performance, with TI increasing from 57 times in 2022 to over 210 times in 2024. This means that Petronas can easily pay its interest with earnings, showing a strong financial health and a very low risk. But for Petron, their TI dropped from 6.82 to just 1.57 in 2024. That means that their earnings are barely enough to cover interest payments, which is a warning sign. Overall, Petronas is in much safer position, while Petron needs to improve its earning to reduce debt to avoid future financial pressure.
Operating margin is a percentage that shows how much profit a company makes for every dollar of revenue. It's also known as the return of sales or operating profit ratio. Based on the given calculations, Petronas appears to be much better at controlling operational expenses and turning a profit from sales by demonstrating a consistent improvement in operating margin, rising from 2.97 in 2022 to 4.08 in 2024, which indicates enhanced profitability and operational efficiency. This positive trend suggests that Petronas has successfully optimized its cost structure, streamlined operations, or capitalized on revenue growth opportunities. In contrast, Petron's operating margin declined sharply, falling from 1.35 in 2022 to 0.29 in 2024, reflecting deteriorating profitability. This downward trajectory may be attributed to rising operational costs, pricing challenges, or reduced market competitiveness, making it more difficult for Petron to sustain its profitability and financial stability. The stark contrast between the two firms shows that Petronas' ability to maintain financial strength through effective cost management and strategic decision making, while Petron faces significant hurdles in profit generation and cost control.
So next is the profitability ratio. So the profit margin is a measure of how much money a company is making on its product or services after subtracting all of the direct and indirect costs involved. So Petronas exhibits a steady increase in profit margin, raising from 2.10% in 2022 to 2.86% in 2024. So indicating a consistent profitability growth driven by efficient cost management and strong revenue generations. This gradual improvement suggests that Petronas has maintained operational discipline, possibly optimizing expenses and enhancing revenue streams through strategic expansion or pricing adjustments. And conversely, Petron faced fluctuating profitability of uh, with the decline from 0.89% in 2022 to 0.73% in 2023, followed by a sharp surge to 5.04% in 2024. So this sudden rise in 24 signals a significant turnaround, likely resulting from the effective cost-cutting measures, pricing revisions, or operational efficiency improvements, while Petron's early decline suggests challenges in controlling costs and maintaining stable revenue. So the substantial recovery in 24 indicates that the strategic intervention or favorable external conditions. So the contrast between both companies underscores Petronas' abilities to sustain profitability growth, whereas Petron's suggests the financial vulnerability followed by a strong rebound. Increase the sharp increase in Petron's profit margin in 24 raised questions about the factors driving this surge, such as cost reduction, one-time financial adjustments, or external market influence. If Petron maintains this upward momentum, it could indicate a long-term stabilization in profitability, provide continuous refining its financial strategy.
Petronas displayed a consistent increase, improving from 9.49 in 2022 to 13.93 in 2024, indicating strong profitability and effective asset utilization. This upward trend suggests strategic financial management, possibly through optimized operations, cost control, or revenue expansion. In contrast, Petron's basic earning power declined sharply, dropping from 9.55 to 2.21, reflecting deteriorating efficiency in generating returns from its assets. The decline may be attributed to rising operational costs, reduced profitability, or asset-heavy investments that fail to yield proportional returns. Petronas demonstrated a consistent upward trend, improving from 7.02 to 9.78, indicating strong profitability and effective asset utilization. This steady increase suggests strategic financial management, possibly through optimized operations, cost control, or revenue expansion. In contrast, Petron's return on asset declined sharply, dropping from 6.31 to a mere 0.39, reflecting deteriorating efficiency in generating returns from its assets. The decline may be attributed to rising operational costs, reduced profitability, or asset-heavy investments.
So Petronas showed improvements from 13.52% in 2022 to 18.20% in 24, so indicating a strong profitability and effective equity utilization. This steady increase suggests strategic financial management, possibly through optimized operation, cost control, or revenue expansion. In contrast, Petron's return of equity declined sharply from 13.56% in 22 to a mere 0.76% in 24, reflecting a deteriorating efficiency in generating returns for shareholders. So the decline may be attributed to rising operational costs, reduced profitability, or capital intensive investments that failed to yield proportional returns.
For the current ratio, Petronas maintained a consistently higher ratio across the 3 years, which indicates a stronger ability to cover its short-term liabilities. Although Petron has shown some improvement, the company still has a lower current ratio, presenting a weaker liquidity position compared to Petronas. For the quick ratio, Petronas possessed a higher quick ratio, which implies they had ample liquidity to meet short-term obligations. Petron's quick ratio is lower compared to Petronas. This suggests that Petron relies on inventory to cover liabilities, which may indicate less immediate liquidity. Petronas demonstrates a more stable and stronger liquidity position compared to Petron, both in terms of current ratio and quick ratio. Petron is approximately weaker in liquidity, especially when excluding inventory.
So next we are going to the book to market ratio. So it's basically a ratio of a company's market value to its actual accounting value. So the higher the ratio, the more investors are paying the company over its book value, typically a sign of high confidence and growth potential. And if a low ratio would suggest the company is undervalued or viewed as more risky. So during the period from 2022 until 2024, the book to market ratio of Petronas was relatively quite high. So it reflects a strong investor's confidence, and the ratio of Petron was quite lower, around 1.6 to 1.2. So as I mentioned, reflecting a more cautious investors despite the stable performance. So here we have the market value. So let's get straight to the point. So in 2022, Petronas had a much higher ratio, which is 27.5 compared to Petron, 12.3, showing that investors were more confident in Petronas' future performance. So, I mean, this likely due to
Petronas stronger brand, it has a larger market share and more stable income, including from non-fuel businesses. So over the next 2 years, we saw both companies saw a drop in their ratios, with Petronas at 20.9 and Petron at 9.6 in 2024. So this suggests that while investors still value Petronas more highly, the market is becoming slightly ever more cautious overall.
Peer analysis is a method used to evaluate a company's financial performance by comparing it to other firms in the same industry. The reason behind this is to help assess competitiveness, strengths, weaknesses, and other areas for improvement. Peer analysis involves benchmarking a company's financial ratios and metrics against industry leaders or direct competitors. This comparison provides insights into relative performance and financial health. In this case, we are diving deep into the oil and gas industry, where we compare the firms Petronas and Petron. As you can see presented here, in terms of all five ratios, Petronas remains dominant compared to Petron. For the liquidity ratios, Petronas has a strong financial health. For the asset management ratios, it shows operational efficiency for Petronas. For the debt management ratios, Petronas has a strong ability to assess its financial leverage and risk. Next, for the profitability ratios, Petronas' performance indicates the company's great ability to generate returns. And finally, for the market value ratios, it reflects Petronas' great investor perception towards the public. Although Petron has shown some improvement in these 3 years, it is still lacking dominance in the peer analysis. However, there is room for improvement.
To sum up, from 2022 to 2024, Petronas consistently outperformed Petron. Petronas kept debt low, profits growing, and showed a strong financial discipline. While Petron, they are efficient in assets, but struggle with weak liquidity, inconsistent earnings, and high debt. To improve, Petron should reduce debt, manage inventory better, and focus on profitability through cost control. Most importantly, it should learn from Petronas Smart, a stable approach. In short, Petronas leads the way, but Petron has potential. Just an urgent action is needed. So, thank you. That's all from our group.